Hey there, everyone. Happy Wednesday. Happy Fed Day, January 29th, 2025. Welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from a sunny and beautiful Redmond, Washington. It's been pretty cold here, lows in the 20s, highs in the 40s. It's been actually quite clear with no rain, and that means we can actually see the stars, which is not often this time of year. It's usually kind of overcast, and you forget that there are stars up there. Pretty awesome. Last couple nights have been cold but enjoyable to check out all the planets and everything. Hope you guys are doing well, navigating a busy market week. I mean, even without the huge drop on Monday for Nvidia and other semiconductors, other technology names, it was already going to be a busy week with the Fed meeting coming out today with a lot of earnings, including some big mega cap Magnificent Seven earnings to debrief on. Got a couple companies reporting today, some after the close, Tesla, Meta moving in the aftermarkets, Microsoft as well. So a lot of things to debrief on. And I will tell you, when people talk about a period like this and they tell me, well, how helpful can charts be? Because it's all about the Fed, it's all about earnings, it's all about DeepSeek AI and all these other things. My argument is this is the perfect time, right? I mean, when there's so many competing narratives, the market doesn't move on a single thing, on a single moment or a single news item. It's an aggregate of all these different things because that's what investors are dealing with. That's what we're trying to digest and then use those data points to inform our decisions, to inform our positioning. So I think charts are a great way of sort of tracking, I mean, legitimately, what is the collective investor? What are we all sort of generally thinking? Are we optimistic, pessimistic, nervous, euphoric, despondent? All of those adjectives, I think, are best reflected in the prices of charts and the prices of the S&P and the major averages. So let's get to the market recap and see how things actually played out today. As a reminder, we are live streaming on YouTube, X, LinkedIn, and Facebook. I appreciate you so much tuning in. Those of you doing so live, if you are tuning in live, you can ask questions at any point. So just drop a question in with any of the comment sections of any of those platforms. I can see them all as we're live streaming, and I'll grab a question or two at the end. Anything we don't get to will go in the mailbag. Planning an all mailbag episode on Friday of this week, and we'll see how much we can get to. But last couple of Fridays have been a lot of fun going in a little more detail through some of those great questions that we've received. I did see a comment of someone that Tony, who joined us for the morning coffee routine webcast we did earlier today. Glad you enjoyed that. It was a lot of fun. I love discussions focused on routines and process. So much of what we do is talking about specific ideas, specific charts. I don't feel like we spend enough time trying to make better decisions by improving our habits and our routines. And I hope you got some of that out of today's webcast. Let's get to the market recap here. So overall, obviously, market net negative. I think the big question mark coming into today's session, two things. I mean, number one, maybe three things. Number one, what sort of continued reaction do we get after Monday's sell-off? We had Monday a big sell-off in stocks like Nvidia. By Tuesday's close, Nvidia had gone back to the lower end of that gap. What happened today? Short answer is more weakness. So, still not breaking down any further, but not really regaining, and see a bunch of buyers coming in and pushing Nvidia higher today. Second thing would be the Fed, and I would summarize the Fed action as, sort of a non-story, particularly in terms of any change, because the market was pricing in a 0% chance of any policy change today. But it was more about the forward-looking aspects, and the summaries I've been looking at, kind of trying to make sense of Powell's comments, particularly in the press conference. Not in a rush to lower rates any further. It's always going to be data dependent, but we can see from the CME Fed Watch, which is a tool that allows you to look at the Fed funds futures market and see what the market is pricing in for potential rate cuts. Market basically pricing in 2 more rate cuts in 2025, and that's it. Meaning at the end of the year, we're only about 50 basis points lower than where we are right now. So we'll look at that. I'll bring up that tool and show you what that means and how that's evolved as we debrief on the Fed. Third thing's earnings, and no big changes going into earnings, I would argue, but some movements after hours. We can see how that relates to the price action. So with all of those kind of 3 key things top of mind among all the other stuff that could come out, the S&P and the NASDAQ basically down about 0.5%, not a huge down day, quite a bit of chop around the around the press conference. 2 o'clock is when the Fed decision comes out, kind of a non-story there, but 2:30 is when Powell's press conference begins. You can see generally we were higher going into the close after the start of the press conference, about 60-15 to 60-40. But overall kind of choppy and not like a big, sometimes you've seen huge rips to the upside during the press conference. We didn't get that today. We sort of got a more measured reaction and more muted than anything. Still, I think markets in a transition phase in wait and see mode. I didn't see anything to change that thesis in the last hour and a half of trading or so. Mid caps and small caps, all about the same. They're all down about 0.4 to 0.5%. So really kind of everything down a similar amount today. The VIX did move slightly higher, but not by much, still around 16.5. So in that 16 handle, we're in the mid-teens, which means low volatility, no real risk. You know, when I look at things like the VIX, when I look at the MOVE index, when I look at credit spreads, particularly high yield spreads, it's all about spikes in those readings that would imply, you know, bond investors being a little more aware of risks or perceiving additional risk, which would cause spreads to widen, which we've not seen. You know, options investors getting nervous and injecting more volatility that would cause the VIX to go higher. Didn't see that. Same idea in the bond markets. You'd see the MOVE index go up. None of those things are happening. They're all kind of remaining fairly low relative to historical levels, telling you the market kind of still okay from sort of a sentiment, I guess, / volatility perception. All right, looking at interest rates, end of the day, no real change. It was a noisy session. So we can see the 10-year yield was down a bit, was up a bit as bonds sold off going into the press conference. Bonds rallied during the press conference and going into the close of bond trading. Bonds actually closed around 3 p.m. Eastern, an hour before stocks. And so as stocks rally, bonds rally as well. That caused the 10-year yield to go right about flat for the day. So we're still just about 4.5%. Long bond yield, no change by the end of the day, around 4.8%. So the bond market, again, kind of a muted reaction. The dollar index has been in a primary uptrend, I would argue, for the last 5 or 6 months. No real change today, kind of flat. So, you know, while a lot of these things could certainly have fluctuated quite a bit, certainly sort of wait and see mode. Maybe this is, you know, not really enough new news from the Fed meeting to cause significant shifts beyond what we've seen so far. Also, maybe a lot of investors waiting on these mega cap tech earnings and communication services earnings, particularly after the news, AI news beginning of this week. So we'll look at those charts here in a moment. But I would say overall lighter reaction than certainly we could have seen on a day like today. Gold slightly lower, silver slightly higher. The GLD was down about 0.4%. Silver prices up 1.33%. Oil prices were down. Nat gas was up. Again, mixed results is what I would say for most of these. The only place I'm not really seeing mixed results is in the crypto space. Bitcoin, Ethereum, the rest of the top 10 coins here on the stock charts platform, all finishing strong today, or at least trending higher through the course of the day. During the equity trading session, kind of moved up a bit. Bitcoin sold off a bit here in the last hour or two, but overall, nice bounce off of 100,000, got down almost to $100,000 a per Bitcoin, but continued to rally through the course of the equity session. Getting us back to currently just below 104,000. We're currently at 103,500. By the way, shout out to my good friend and crypto expert, Adrian Zadunchik, Crypto Burb. And what Adrian had just put out was a chart, kind of a "you are here" chart, looking at traditional Bitcoin halvings and what has happened afterwards. If you remember last spring, it was kind of in the April-May timeframe, we had the most recent Bitcoin halving, and that is when the Bitcoin mining reaches a certain threshold. The value of each mined Bitcoin goes down by 50%, and so it's called a Bitcoin halving. It's happened, I think, 3 other times in the history and the short history of Bitcoin. Generally speaking, the next 12 months have been remarkably strong. We talked about that in my Stock Charts TV days when I was doing the show over there. We talked about that Bitcoin halving and had Adrian on the show to talk about it. And so far, it's been pretty good in terms of the post halving performance since April of last year has been remarkably strong. So overall, continuing to show some strength there. And interestingly, kind of disconnecting a bit from the performance of the equity markets. All right. Looking at the 11 S&P sectors, 4 up, 7 down. The 4 sectors that were up: communication services. Now, Meta is one of those 3 names reporting after the close today. Meta, Microsoft, Tesla are the 3 Magnificent Seven names on the earnings docket today. Other earnings names on there, of course, but those are, I think, the three important ones to watch. Yeah, it looks like Tesla was gapping lower in the after hours. Meta pushing higher, certainly. We'll look at how things play out as investors digest the results and then the earnings calls get going. Still kind of in the process of digesting those, but Meta certainly has been one of the best charts in the Magnificent Seven for sure. One of the few making new all-time highs in January. The XLC, which is Meta, one of the bigger weights there, up 0.4%. Consumer staples, a fairly defensive sector, number 2. Energy, number 3. Utilities up as well, but none of them up a ton. I mean, these are up just slightly from yesterday. On the downside, real estate, the worst performer, down 1.2%. Technology, which of course includes Microsoft, Apple, which has not been a particularly great chart recently, certainly the worst performer out of the Magnificent Seven, I would say, in January, maybe followed by Tesla, and what else do you have in tech? Nvidia and all the semiconductor names. So kind of pushing back down today. Tech down 0.8%. Healthcare third from the bottom. So kind of 7 down, 4 up kind of day here. Looking at the breadth, I mean, not great, but not horrible. We've had worse days recently in terms of the breadth. This is just looking at daily advancers versus decliners. You can see in the S&P, which is right in the middle, 60% of the S&P members down to 40% up, kind of a 6-to-4, 3-to-2 ratio, down versus up. Kind of a similar reading across cap tiers and across different slices of the equity universe. So overall, not a great day there. I meant to switch that back to the S&P 500. Yeah, F5 networks. I was going to say I didn't actually grab that chart, but popping up here. All right, there's your quiz of the day. Anyone know what this candle formation is? This, in an uptrend, you have a big, open and close near the highs of the day, a long lower shadow, limited upper shadow. Do you know that candle pattern? I know a number of people have just passed their CMT exams. I'm planning to sponsor a couple of them for their CMTs, which is always it's always great to see people get good results through there. But if you've studied for your CMT, you had to know all of these candles. This is actually called a hanging man candle. It is as foreboding as the image would imply. Hanging man, there's like the head, the open and close, and the long lower shadow. When that happens, when you're in an uptrend, you have that candle. It actually is a reversal candle because what it means is even though you open, traded lower, and closed higher, the fact that it happens and you don't really gain a lot after the open, right? So the open and close are right around the same level. It suggests indecision. So a lot of candle patterns when the open and close are near one another, a doji candle or a hammer candle or a shooting star, in this case, a hanging man, or just different ways of describing those different patterns. And they're usually reversal patterns because they imply an exhaustion point, indecision, which usually means whatever trend was going into this is probably weakening on the other side. So something to think about for something like F5. SBUX, which was the second best performer in the S&P. I actually did grab that chart. We'll review that a little later in the show. Netflix, Apple, Meta all up during the trading session today. Netflix, the best performer, up about 0.7%. They were, I think, the first of these names to report last week. Nvidia down 4% today. Tesla 2.25% going into earnings. It's down a little further in the aftermarket. Microsoft about 1.1%. Didn't look like a lot of movement after hours so far, but we'll see how things play out there. All right, let's look at the market carpet. The market carpet. And as a reminder to bring up the market carpet, I can't see the questions that are coming in on the different platforms. Drop a question as we go. I'd welcome that. I appreciate those of you tuning in live. We'll grab a question or two before the end of the show. Anything we don't get to, we'll put in the mailbag for Friday's episode. Well, if you like the color, neutral beige-ish, then this is probably a pretty fun day because I would say that's the net aggregate color that I see here. It's worth noting. I mean, one observation: the big names beside Nvidia down another 4% today, and it's obviously been quite choppy the entire week. Besides that, and maybe Tesla down 2.25%. Kind of a big nothing burger of a day. If you look at Apple, Microsoft, Alphabet, Meta, Amazon, even some of the big banks like Berkshire, JP Morgan. I know Berkshire's not a bank, but the big financial stocks. No real movement. And the biggest names in most sectors did not have a particularly big day either way. And so this is very much a neutral kind of, hold our breath and see what happens kind of a move. And I would say on a day like today, where the benchmarks were essentially flat, stocks that had big movements really stand out, right? So anything on this heat map bright red, something's happening. And that's not a market thing, right? I mean, when everything's down, you can tell, all right, people are just selling and unwinding positions. When, everything's green, it's sort of okay, everything's kind of working, rising tide lifts all boats. People are just adding positions. A day like today, the market itself, in terms of the benchmarks, didn't really go anywhere. And so anything that moved a lot, it's probably more of a stock specific issue or a group issue, something that could be an opportunity is my point of that, right? And, sometimes when stocks move, you wonder how much of that is just the market impact and how much of that is the actual name. A day like today is actually pretty clear because anything that moved, it was something with that stock that caused it to disconnect from the general kind of sideways movement in the market. So I'm immediately drawn to charts like AMD. Again, I mean, a pretty ugly chart over the last year, but having a decent bounce while the markets were down. T-Mobile, which has actually recovered quite nicely, pulled back to almost 210, kind of aiming back toward those previous highs from around Thanksgiving. Some of the renewable energy names, and again, some of these are pretty rough, like First Solar. I mean, ugly trends over the last 6 to 12 months. But getting a nice counter trend bounce today, so those kind of moves stand out to me. And F5 Networks hitting $300 a share here, new all-time high, and just continuing to be long and strong up and to the right. Other names that stand out: Starbucks breaking out, which is a pretty compelling move, pushing above 100, big round number, and continuing today. Nike potentially making a big double bottom pattern. I actually didn't grab that chart, but I'm making a note to take a look if time permits, because that could be an interesting play as well. Then the opposite, look for those names on the downside. We don't have time to go through all of these, but some of these names that actually were down while the market was flat. Again, that tells you something is happening with that group, with that name. But I think those movements either way are kind of magnified on a day like today. So I'd encourage you to go through and look for some of these stocks that had decent moves on a day when the market was relatively quiet. Those could always be some opportunity. All right, let's finish off looking at our chart review. I'll take a question or two. We'll be done for a beautiful Wednesday afternoon. S&P 500. So here's the thing. We highlighted this gap, right? And this is the island reversal someone mentioned earlier in the week, where we had a gap higher, a couple days trading, gap lower to start this week. Yesterday, of course, nice recovery off of those lows. Today, what's called an inside day. So with bar charts, you often talk about outside days or inside days. And that basically just means in a 2-day pattern, what's the range, high to low range of day one? What's the high to low range of day two? This is a bearish inside day pattern. We have an up day followed by a down day, and the second day's range is tighter. It's within the first day's range. And if you think about what that kind of looks like, an up day, a lower open, a down day that didn't quite get to yesterday's close, it really is kind of a consolidation, but a reversal pattern. So bearish inside day. If you're a candle chart fan, I feel like this is a candle chart masterclass. Call it a bearish harami pattern, which is a kind of the opposite of an engulfing pattern. A big up day, a smaller down day. Again, both of those, whatever you call it, it's not bullish, because what that means is yesterday was a nice kind of up move bouncing off of Monday's close. Today we gave back a good amount of those gains, and so it suggests sort of a short-term reversal in sentiment. For now, I would say the longer term, sort of the overall picture has not changed a ton here. The last 2 weeks, we, started with a failed breakdown, what looked like a perfect, not a textbook head and shoulders pattern. It was not a perfect one to start with, but certainly looked like we had a clearly defined neckline and a breakdown below there. We never got a lower close, and that's something I'm keeping in mind as I review what I learned from this sort of drop. And then we sort of traded back within the range of the pattern and then broke above the upper trend line. We regained the previous highs. That's all constructive, but then we never followed through above 6,100. And so what has essentially happened, this island reversal kind of happened right at the previous highs, right at the December peak. Now it's sort of wait and see mode, right? We gap down. We're sort of within the range of the gap. I think this is a very much a question mark kind of period. Again, Jesse Livermore, which I love to quote, there's time to go long, time to go short, time to go fishing. This is one of those times when I think it pays to sit on your hands and wait to see which way this resolves. I would say there are plenty of arguments for why the market should go down, given, the conditions that we've seen, given the fact that the new high about a week ago was on much weaker momentum. That's just a classic divergence, and I think the daily chart will certainly reflects that. Having said that, we haven't broken down a ton, right? After Monday's gap lower, we've kind of recovered a bit. So, still, I think this market now all of a sudden feels, I guess the way that I would think of this market, and I don't know if I'm going to leave this annotation on here, but I'm kind of seeing it like this. Let's see, we'll make it like a light shade of blue. I mean, I'm kind of seeing it like this, right? I mean, this is kind of what the market's doing. You had the big uptrend into the fourth quarter, kind of November, December. We're making new highs, hitting 6,100 for the first time. And then from there, we've traded to the lower end of the range. We've tried to break down and have failed to break down. We traded to the upper end of the range. We tried to break out and then failed to hold it. I mean, I think a breakout above 6,100 is a really nice a resolution of that consolidation. I think a breakdown below 58.50 and a follow through would complete that. Until then, it's a choppy, sloppy sideways tape. That is certainly how it feels. That's kind of how I'm looking at it. I don't know if I'm going to leave that rectangle on there, but I'll think about it. All right, let's go through some other charts here to continue the thinking. In terms of breadth conditions, breadth's actually been pretty noisy this week on the McClellan oscillator above zero, which is good. A lot of stocks kind of rotating lower today. Here we have the percent of stocks above their 50-day moving average. It was around 60% yesterday, down to around 51%. That means around 9% of the S&P members, that's what, 80 stocks-ish, went down or broke below their 50-day moving average today. So, again, it's still fine. We're kind of right at a coin flip, but this sort of late January rally was marked by a lot of stocks. Most everything was below its 50-day, and all of a sudden, 6 out of 10 are back above there, which means a bunch of stocks broke back above their 50-day moving average. All of a sudden, this week, sort of a question mark on that. And I think whether that 50% level holds could tell us whether a meaningful push above 6,100 is even possible. Because if more stocks are breaking down, that's not great. And again, what this also brings to mind is from November, December, January, less and less stocks are above their 50-day moving average on each one of those, right? Back in September, October, it's around 80% of stocks above their 50-day. Here in November, it's around 70. This week, it's up to around 60, which means every time less and less stocks kind of regaining the 50. That doesn't feel good to me. For sure. Long-term breadth's still fine, right? Most stocks above their 200-day moving average. There's plenty of room for that to still hold. But I'm certainly, keeping an eye on those breadth measures rolling down a little bit. All right, Nvidia. I'm keeping Nvidia and semiconductors on here every day, just because I think day to day this is pretty topical and important to follow. Big story on Monday, of course, DeepSeek AI completely disrupting everything you thought you knew about Nvidia's dominance in AI brought into question. Yesterday there was a lot of comments on like that was it. That was the correction. That's it. And now Nvidia is going to go back to new highs. I was definitely not convinced on that one because, yesterday we really just remained within the range of Monday. Today, we continue to be within Monday's range. So I would say this is still the market digesting what we learned on Monday. If a bunch of people were optimistic and buying up Nvidia, the price would be going back into this consolidation phase, kind of in that 130 to 150 range. It's not happening. If everyone was totally panicked, Nvidia would have just kept going, and a falling knife would happen, and we're kind of down toward 100. That's not happening either. So I think investors are realistically, or I guess reasonably confused as to what the long-term impact is going to be. The short-term impact is, this could be an issue. Is it legitimately an issue? That's still an open question, and it's all speculation at this point because there's still a lot we don't know about this new AI. Probably even just from Monday to Wednesday, I'm seeing different headlines about did they actually use Nvidia chips that were, and who knows? I mean, I think it's still an open question. So, the market is in a period of indecision. That's what the chart looks like when that plays out. Now, semiconductors look a lot like Nvidia, except we've broken through the 200-day and we're failing to get back above it. Today, we opened at the 200-day and closed a little bit lower, but we're still within kind of that sideways range. So the S&P semiconductors are choppy sideways open question. I think a break out of this range is what you're waiting for, and we haven't really seen a decisive one in either direction just yet. All right, but look at Microsoft, Meta, and Tesla. What I was going to do is just look at the chart think about what we learned going into today's earnings announcement, then look at what happened after hours. Again, after hour sessions, lighter volume, is a lot of noise. Who knows? I think, it's just sort of an initial read on how people are reacting to earnings. Tomorrow is where you really sort of, see how the bulk of investors and the investing community is, processing and interpreting the earnings numbers and the earnings calls. But I would say for now, I mean, Microsoft has not been a particularly strong name, particularly when you compare it to charts like Meta and Amazon and Alphabet, which are in clear uptrends and making new all-time highs in January. Microsoft's still below its July high from last year, right? And so we had this nice kind of breakout in December. Looked like we were going to regain the previous high. We failed back to a new swing low. Now we're kind of within this range that we established from mid-December to early January. So, for now, I mean, at the least, I think you want to see it get back above the previous swing high. Higher highs and higher lows are bullish. So I would love to see that pattern continue. Let's look at what's happening here for Microsoft after hours. I mean, down slightly, right? It's around 433. So we're currently trading. I mean, we're kind of down in this kind of range. That's still within, yesterday's trading range, kind of back toward the 50-day moving average. With this kind of chart, I mean, you'd want to see moving average support hold. That would be more constructive. But again, this is not a great chart. I mean, again, if you look at the weekly chart, it's a big sideways trend here for the year. And that is exactly what Microsoft has been, while other names have been much more successful. Example A would be Meta, up about 1/3%. I mean, this has been a great chart. We've considered this kind of a core holding, long and strong. Charts like this that keep making new all-time highs, that keep having resistance levels that are eclipsed. I'm going to assume that trend continues until proven otherwise. After hours, looks like up another 5%. So we're up around 711, which is kind of way up by the trash can icon up here somewhere. So certainly a nice bounce. Initial reaction from what I heard, and again, I don't get a chance to dig too deep into earnings before I do the show on a given day, but it looked like numbers, earnings numbers stronger for the quarter, but the forward-looking guidance was lower than the street had expected. So it's sort of some good, some bad. Looks like during the call, it's a little more optimism being fueled. So up 5% in the after hours. Again, I'm not surprised. I'm surprised when a chart like this, trades aggressively lower, because from a technical perspective, this is a strong chart, the type of thing I would want to have exposure to as long as that trend persists. Certainly appears to be doing so. Tesla reminds me a lot of Apple. I would say between Tesla, Apple, and then maybe Microsoft would be the three weakest of the Magnificent Seven sort of group of charts. These are the ones that are not breaking out and not really threatening to retest. In the example of Tesla testing its 50-day moving average, 380 and the 50-day are kind of those levels we're watching. Overall, this is not a great chart. I think the lower high around 440 is a concern. So I think of a chart like this as guilty until proven innocent. Proven innocent would be we get above 440. So it's sort of tilting more negative on the chart of Tesla. Oh, it looks like we're up a little bit in the after hours at about 6 points, 395, which would take, it's really not, it's sort of within today's trading range. So no real movement in the after hours just yet. Again, I think 380 holding would be pretty crucial here, because if not, that means we're not making, we're making a lower high and then a lower low. So I'm concerned about that below 380. That's a pretty ugly chart. I'm setting a reminder to set that alert. I thought I had that, but I don't know if I do. Nvidia, shout out to fellow CMT Todd Stankiewicz. Todd wrote for the Investopedia Chart Advisor. My friends at the CMT Association, other strategists like myself, technical analysts, have written articles for that daily market newsletter focusing on technical analysis in partnership with Investopedia. I've written for them. I'm actually slated to write a week's worth of articles later, maybe February, March, somewhere in there. I forget where I agreed to do it, but at some point. But Todd had a really good chart looking at the weekly chart of Nvidia. So Todd, thanks for including this in your report. Full credit to you for coming up with this visualization. But you're looking at the weekly Bollinger Bands on Nvidia. We've highlighted this chart. We've looked at the daily movements, I feel like, a lot recently, but looking at the weekly chart is really helpful. And his point was, look back at all of these times where we held the lower band there in late 23, here in early 21, here in early 20, here in mid 19. You contrast that to the times when we failed to hold it, like here in early 22, which led to another 6-month decline here in fourth quarter of 2018, which led to a pretty significant decline going into a December low. So the ability to hold the lower Bollinger Bands, particularly in a period of volatility contraction, is pretty good. And you can see a number of times where that's actually been a really good sign, contracting Bollinger Bands, which means volatility is coming in. We hold the lower end, the lower band, and then break above the upper band. The question was, does that happen? Because this week with the gap lower, we're right at that lower band. I thought that was great work, sort of, comparing buyable pullbacks with further breakdowns, and the ability to hold the lower band after a contraction period was pretty key. I'll definitely keep an eye on this. And again, Todd Stankiewicz, CMT, thanks so much for including that in your work this week. Synchrony Financial, I actually had this on the list yesterday. I didn't get to it. I just want to point out with some of the financial stocks, good. My initial reaction looking at the chart from top to bottom, right to left, right? If you start at the top, pretty encouraging because we gapped higher in November. We are holding that gap range, right? We pulled back to around 62, 63 a couple times and have held that, holding for now an ascending 50-day moving average. I think all that's constructive. What concerns me is this. A lot of names like this that have had good runs higher, and you're seeing them in the financial sector, certainly in some technology names, some other sectors as well. Higher highs November, December, January on weaker momentum. That is often the sign of the exhaustion sign of a long-term uptrend, right? Is when you see those further moves to the upside and on deteriorating momentum. Now, again, for me, that on its own does not tell me to sell something like this. I don't own SYF, but if I did, I probably wouldn't just sell it just because of a bearish divergence. This puts it on an important watch list that I would keep a very focused eye on, because what this tells you is these are things showing signs of similar toppy stocks. Do you see the breakdown? So this puts it on the list, and I set an alert for like 62, which would mean we break below that that short-term support. I know I don't have that set, and I'm going to set that alert as soon as we're done here. Keep an eye on that one. And I'm concerned by some of the banks that have looked so strong, but starting to make new highs on weaker momentum, which is less ideal. Starbucks, finally, we've got a couple more charts to finish off with, then I'll take a question or two. With Starbucks, strong day today, reported earnings yesterday. Pretty successful, up about 8% today. So despite the market going nowhere, this is one of those names moving significantly on a flat market day. That tells you there's something company specific, and it was a really strong earnings report. On Tuesday, we closed just above $100 a share, big round number support right below those November highs. We actually resolved that to the upside. This isn't like a perfect cup and handle pattern. I'm not going to suggest that it is, but if you draw a line through any of these major tops, today's action certainly gets us above there. We'll see if we get follow through tomorrow. But if you look at the weekly chart of Starbucks, really starting to improve here. This could be the catalyst to drive the next leg higher. We're going to talk about BridgeBio Pharma. This is a name I don't know if I've ever talked about. It's a mid-cap name in the biotechnology space. Someone put this in the chat yesterday. I didn't see it until after we wrapped. So instead of keeping it for the mailbag, I thought I'd just throw it out here. Great chart is my short answer. And I will tell you what I like about this chart. I like charts that rotate from a distribution phase to a consolidation phase to an accumulation phase. And I think this chart sort of encapsulates those three kind of general things. And I'll show you what I mean here. What I mean is we start with, and I'm just going to draw some, poorly drawn, but just kind of general lines here, right? So you have a distribution phase, a pattern of lower highs and lower lows, which tells you overall more sellers than buyers, and not a lot of people excited to own this stock, as evidenced by the fact that short-term rallies keep getting sold. We keep making new lows. That all changed kind of in this period, where we see more of a consolidation phase. We can encapsulate most of this action in a rectangle shape because we have a consistent resistance level around $30. We have a consistent support level around 22. A lot of charts we've talked about here, like semiconductors, right, are in sort of a rectangular shape. You call that a consolidation phase. And that's what I think about a sideways movement. Buyers and sellers are basically in agreement. The market's telling you the stock's worth about $26 a share, and we're just kind of overshooting and undershooting that equilibrium value for the stock. This pattern is done when we break out of it, right? And so once you see a big move to the downside, that would obviously be pretty bearish and would suggest a new distribution phase. But to the contrary here, a couple weeks ago, we actually get a break to the upside. We push above 30, which suggests something's new. And I don't know anything about the fundamentals of this company. It was a purely technical observation. But I would say now that we've broken out of this range, this suggests to me we're in a new accumulation phase. And now, now you start to look at the lows. Now you start to look at this as an uptrend channel of higher highs and higher lows. This is an accumulation phase where as long as we keep making higher lows, that means investors are buying in on weakness. Stan Weinstein did a great job, obviously writing books on what he called, I don't know, he calls it his I forget what it's called. Oh man, I think it is the phase strategy. What is it? Blanking. Too many things, but he describes them differently as different labels, but it's that same idea of just identifying which pattern they're in. And I know a number of strategists, Craig Johnson at Piper Sandler comes to mind, who's made a career out of identifying where we're at based on moving average combinations and things like that. I tend to simply look at a chart and evaluate, are we in an accumulation phase, a distribution phase, or a consolidation phase, and bet yourself. Stage analysis, Papa Proper, you win the prize. Thank you so much. I couldn't come up with the word. You win. Well done. Stage analysis. Weinstein's stage analysis. It's on the tip of my tongue. So by my vernacular, I would describe that as an accumulation phase, which means, people are buying in on weakness. This is an uptrend phase. I think BBIO, again, I don't know a lot about this stock, but I would say from a technical perspective, that is a beautiful demonstration of the type of breakout of a base that I love to look for and I love to take advantage of in my own portfolios. I did mean, by the way, and we'll take a question or two here to wrap up, but I did want to point out the Fed Watch tool, just wrapping up with Fed Day. Again, today was a non-story in terms of changes to policy. There's no real change to the target rate, and that was pretty much what the market's pricing in. The CME Group provides a free tool on their website. This is we used to do this in an Excel spreadsheet back in the day, 20 some years ago, because when you look at the futures market, you'd enter this stuff and you could sort of triangulate or interpolate where the market was pricing in certain rate changes at certain future meeting dates. And so you can see tabs here for each of the upcoming meetings. You can really go through the end of the year. You can go further if you want, but I would say it's less meaningful a year plus out. But looking at the remaining meetings during 2025, what this is showing you is here's the current rate, 425 to 450. This is the next meeting, which is about 6 weeks out, mid-March. And the market's saying about an 82% probability that rates are unchanged, about an 18% probability that rates are lowered by 25 basis points. Now, a month ago, it was a coin flip, about a 50-50 chance, and actually even a 4 to 5% chance that it's a 50 basis point or 50 basis points lower, essentially at the March meeting. So that shows you how the appetite for rate cuts has lessened as the Fed has made comments like they did today, saying there's not in a rush to lower rates. And then the May meeting, which would be another 5, 6, 7 weeks after that, you can see about a 58% chance that rates are exactly where they are today, about a third of a chance, 37% chance that they're down a quarter basis point, and only a 5% chance they're down 50 basis points 2 meetings out. So if you go all the way out to October, December, you're still getting, at most a 50 basis point cut between now and then, which basically means the market's pricing in 2 cuts for 2025, and that's about it. And this is a long way from a bunch of rate cuts that were priced in or sort of within what people were expecting not too long ago. So keep an eye on that. That's at cmegroup.com. It's called the Fed Watch tool, and I encourage you to experiment with that and just dig into the data. It's pretty helpful. 3P Investor, thanks as always for watching. I know you're a frequent watcher. I appreciate it. I know you don't give importance to aftermarket trading and numbers, but it was interesting. Tesla going down for a while, but bounced right back and went up. Yeah, and to be honest, I don't want to say that those periods are unimportant. And I've known people that have made a living out of trading just pre-market. I had a friend of mine based in New York, and he literally would get up early every morning and just trade earnings pre-market and would just do quick swing trades, quick day trades based on that volatile period. And again, if that's what you want to do as your investment strategy, I mean, God bless, good luck. I wish you very well. That is just not how I think of it. So, again, for me, after hours trading is more, you think of it more like indications of interest or sentiment indicators, which kind of give you an idea of where the market is at. I think until the full sort of the, pit session, the normal day session is open, I think it's a lot of volatility and it's sort of the market doesn't really know what it thinks yet. And there's a lot of sudden reactions to every little headline and every little sentence in an earnings call. I'm happy sort of digesting that and being a little more thoughtful about what I see. So for sure, you've actually seen quite a bit of noise with Meta, which was kind of flat right after their announcement and has rallied a lot after. Tesla kind of popping up and down. That's what happens. There's that initial report, but then the earnings call is where there's a lot of questions and a lot more color, and that's where the markets can move quite a bit. On X, Bachmanity Capital. I love that name. If that's a reference to a composer, Bach, I'm a huge fan of that. But you asked, do you watch futures market or is this just single stock commentary? Yeah. So my particular process, if you're new to the show, I'm so glad that you watched. I sort of do a mix of things. I don't look at a lot of futures. I look at commodities and I look at the equity indexes. I really don't look at index futures anymore. I used to when I worked with a lot of hedge funds and trading desks that were trading futures primarily. For me, my main areas of focus are equities and ETFs. But what I learned at, there we go, Silicon Valley, right? What a great show. That was a classic show. My wife and I loved that one. Erlich Bachman, just an awesome one. Anyway, great character. Anyways, I've learned as an equity investor, if you really want to invest in equities and ETFs with a well-rounded approach, you need to understand currency markets, commodity markets, interest rates, because they all impact things. And I remember meeting, going up to Fidelity and meeting with, guys that were studying airlines, and it was all about oil prices and what that meant, and thinking about supply and demand within their industry group, and just recognizing how much you looked at other things to really be able to value what these companies were doing, their ability to grow earnings over time. So my technical approach has really embraced that as well. So that's why. Chris, watching on YouTube, any update on our favorite Hindenburg Omen with the yield curve uninverting? I'm starting to see writing on the wall that the peak may be in. So here's the thing, right? I would say when you think of the market on a couple different timeframes, and Chris, I appreciate your question very much. If you think about the market on a couple different timeframes, right? We've got the day-to-day movements, right? The short-term movements, things like Nvidia gapping down. That's a sudden reaction to a news headline that is perceived as threatening Nvidia's business. So the market prices, dings it very quickly. From there, now it's more of a, hold on, what does this really mean? I mean, what does this new AI model actually represent? How did they create it? What does that mean for how we should be valuing a stock like Nvidia? That takes a little longer for people to kind of figure out, and we may never know all the details, but it's certainly more of a period of digestion. That's an example. So in terms of the macro environment, I would say there are some big long-term themes that concern me. A rising rate environment is certainly part of that. The yield curve becoming a more normal shape is a part of that. I would put the Hindenburg Omen in one of those kind of big picture, like macro themes for, a sort of 6-month period that tells me, while it doesn't, Hindenburg Omen doesn't tell you tomorrow we're going to sell off 20%. It tells you we are looking very similar to previous market tops. Now you look for signs of a valid breakdown. So I think those headwinds to further market gains are very real, and I don't want to imply that those are not very much still there. On the medium-term time frame, I would say it's more about the bearish divergences that we've seen, the breadth and the lack of breadth expansion. These are things that tell me from a technical perspective, the uptrend phase is losing its steam, and it feels like we're more in the 8th or 9th inning as opposed to 2nd or 3rd inning, or since we just wrapped football, we're in the 4th quarter and not the 1st quarter of the bull market phase. In the short term, though, and that's where you get to the tactical, all right, where we're actually seeing a breakdown, and we're not yet, right? We sort of saw choppiness, and I think that chart of the S&P tells the short-term story. It's neutral. So I would say the long-term, kind of medium-term for me feels more toppy, feels very headwind, limited upside, chance of downside. I want to be more defensive in my thinking. In the short term, we haven't seen breakdowns to the degree that tell me today is the day when you really start unwinding, at least for the medium-term time frame, because things are holding up. They're not breaking out necessarily. They're not breaking down. Having said that, having described the macro environment that way, I would say remember that a lot of stocks like Meta are just fine making new all-time highs. AT&T, there's a bunch of others making new highs. If you scan for stocks making new 52-week highs, you will see them. I would continue to focus there for areas where we're continuing to see strength despite questionable market conditions. Folks, that's it. Thanks so much for joining me here on Chart This with Dave Keller. It has been such a fun experience doing the show. I really, in case you can't tell, I enjoy what I do. I enjoy doing the show. I enjoy answering questions from all of you, and I really appreciate you helping me make this something that I can do professionally. So thanks so much for tuning in and for asking great questions. We are planning an all mailbag episode on Friday. Our podcast is out and about on all the major podcasting platforms. We had an interview yesterday with Peter Bookvar. Peter is the Chief Investment Officer at Bleakley Financial Group. Things like the Fed, the dollar, interest rates, if that sort of thing is something you want to get your head around, listen to that interview with Peter. He's a really smart guy, really knows the material well, and it was an awesome 20, 25 minutes asking him any question I could come up with and seeing how he was perceiving it. So I'd encourage you to check that out on our YouTube channel. For Market Misbehavior, I'm Dave Keller. Have a great night, and remember, it's always a good time to own good charts. Take care, everyone.